Is it green? It's green.
So, and presumably we will be getting live very soon.
Good. Oh, no, because it sounds quite different now that I'm speaking live.
About 15 seconds till we go.
One reason why the whole issue about financial stability is very dear to OMFIF's heart is that when we had this idea of setting up OMFIF, I wanted to call it OFIF, the Official Financial Institutions Forum. Good. Welcome, everybody. Those who are listening online, this is David Marsh at OMFIF in London, and I'm here to introduce Nat Benjamin, who's the Director for Financial Stability and also on the Financial Policy Committee at the Bank of England. And I was just telling a little anecdote about why financial stability is important for OMFIF, because we were originally going to be called OFIF, which you might say is a more reasonable name. And then a very good friend of mine at the Bank of England, a man called Stephen Collins, you may remember him. He was the Director for Business Continuity, which I guess they used to call financial stability in those days. He said, well, I wouldn't call it OFI, because that's our acronym for the other financial institutions, the OOFIs, the one who are going to go bust. So the reason why the name has become even more awful with the M in it is because of the Bank of England. So I just introduced that to let you know you've got a lot to answer for. That. So Nat is going to be speaking about liquidity and risk and all the things dear to his heart. He's had a stellar career at the Bank of England, looking after banking and also being in charge of a lot of these arrangements that we have with other countries, including the United States and the Federal Reserve Board. So clearly, one of the questions coming up afterwards, I'm sure, will be the present state of the United States and whether or not this is adding to additional risk. But first of all, let's listen to your speech about liquidity and risk. Let's all take note of it, and then I look forward to the Q&A afterwards. Thanks very much for being here, and Nat, thank you for being with us today.
Brilliant. Well, thank you very much for having me. Can you hear me? Well, I can hear myself, but is it working, this thing? Yeah. Brilliant. Well, thank you very much. Thanks for having me. It's a pleasure to be with you, and you've got fantastic premises. So a big congratulations.
If you want to think that these are our premises, you may.
You don't need to say that. Just pretend it's yours. It's very beautiful. Thank you. Great. So it's a great pleasure to have this opportunity to speak today. Last week, we published our latest financial stability report, which provides the Financial Policy Committee's view on the outlook for the UK financial system in terms of the current conjuncture, as well as several structural matters. And today, I'd like to take a further step back and talk about some long-term trends that will affect the future funding and liquidity environments and how we policymakers are thinking about liquidity flows across the financial system as it evolves. The bank's approach to financial stability focuses on the role the financial system plays in providing vital services to households and businesses, and in particular, its ability to do so in both good and bad times, as disruptions to these services have large and persistent economic costs. And for this to happen, requires liquidity to flow to where it's needed most across the financial system, so that financial institutions have the funding they need to operate effectively. And when we think about that, we need to consider how the provision of financial services to the real economy has been changing over time. And in particular, we need to take into account the growing importance of non-bank financial institutions, NBFIs, which now play a more significant role than in the past. NBFIs now account for around half of assets in the financial system, both globally and in the UK. In the UK, market-based finance has accounted for essentially all of the growth in UK corporate credit since the global financial crisis, and now accounts for 50% of the stock of corporate lending. NBFIs play a key role in the provision of a range of financial services to households and businesses, operating both alongside and in partnership with banks. They provide services directly, such as financing, insurance, hedging products, and long-term savings. And they also support other direct providers of financial services, for example, by lending to banks in wholesale funding markets. Their activities provide liquidity and depth in the gilt market, which serves as the risk-free benchmark for a range, a very wide range of sterling-denominated debts, such as corporate bonds. NBFIs also play an important role in the SONIA interest rate swap market, which is used by banks to hedge their interest rate risk and has a big influence on the pricing of fixed-rate mortgages. This has brought many positives, including cheaper and more diverse financial services to the real economy. But it has also come with the emergence of new types of risks emanating from the NBFI sector, and therefore made it increasingly important to consider the liquidity needs of NBFIs, whereas traditionally the focus has been on the liquidity needs of banks. We also have to consider the resilience of the channel through which NBFIs access that liquidity. Risks in the financial system have transformed in other ways, which pose different liquidity challenges. Derivative markets allow financial institutions to hedge their risks, thereby indirectly supporting the provision of financial services. And post-GFC efforts to strengthen the role of central clearing and improve bilateral margining practices have been successful at reducing counterparty risk in the trading of derivatives. However, these changes have also increased liquidity risks arising from margin calls in times of stress, and more of this risk now sits within NBFIs, something we have talked about before. Similarly, repo markets are used by financial institutions, including NBFIs, to manage their day-to-day liquidity and collateral needs, as well as to obtain the funding they need to invest in financial assets, thus supporting the real economy. They allow financial institutions to lend to one another, essentially as collateralized loans, reducing counterparty risks. However, repo borrowers are exposed to liquidity risk as they may have to top up the collateral backing their repo loans if the value of that collateral falls sharply in stress. And we've talked in the past about how this can be exacerbated by sharp rises in repo haircuts from currently very low, often zero levels, and the consequences for financing conditions in the real economy. These long-term structural changes are not new, and we have been talking about them for some time. But these different types of risks emerged against a backdrop of abundant liquidity, which dampens them somewhat. This may no longer be the case as the funding and liquidity environment has been changing over recent years. It's important for us now to consider whether liquidity is able to flow to where it is needed for the financial system to support the real economy, both in normal times and in stress. And in doing so, we should recognize the more significant role that NBFIs play in providing that support. We're moving away from a post-GFC monetary policy stance of very low interest rates and very large central bank balance sheets where central bank reserves are abundant. This is a significant change given the key role central bank reserves play in how liquidity flows through the system as the safest and most liquid of financial assets and the ultimate means of settlement. In the UK, the Bank of England's own balance sheet is shrinking as extraordinary monetary policy measures introduced in response to the global financial crisis and COVID are being unwound. As a result, the overall stock of reserves in the system is decreasing, and the way in which these reserves are supplied by the bank is changing. As set out previously by several of my colleagues, we are transitioning towards a repo-led operating framework where the size of our balance sheet will reflect the liquidity needs of the system. This transition will require a change in how banks and non-banks manage their liquidity. In December 2023, we set out how the change in central bank balance sheets was leading to a number of system-wide trends that were likely to affect bank funding and liquidity. And we have consistently highlighted the need for banks to factor these trends into their liquidity management and planning. Sorry, something happened in front of me. Just talk amongst yourselves. For example, the cost and availability of reserves will affect banks' decisions to hold them versus other high-quality liquid assets, HQLA, that can also be used to manage their liquidity. There are now some way we are now some way through this process. The bank's reserve supply has fallen to around 680 billion from a peak of nearly 980 billion. And asset purchases are being unwound through quantitative tightening, QT, while cheap long-term funding provided through the bank's crisis-era term funding scheme for SME lending is maturing or being repaid early by banks, with the amount outstanding declining from 193 billion to 83 billion. The banking system has been adjusted to this change. Despite a shrinking supply of reserves, banks have maintained robust liquidity positions with aggregate liquidity coverage ratios of 153% and 285% for large and smaller banks, respectively. Larger banks, in particular, have been replacing central bank reserves with gilts in their HQLA, their high-quality liquid assets. And banks have increased their usage of both our short-term repo and indexed long-term repo operations as intended. That has helped smooth through frictions in money markets and ensure that the supply shrinks at a manageable pace. By adapting to this change, the banking system has been able to continue to support the real economy. Lending growth has picked up. Gross lending to households and businesses was 13% higher in the first 5 months of this year compared with the same period in 2024, with increases seen across all asset classes. Our most recent agents' intelligence suggests that SME financing conditions have improved and are now close to what agents would assess as normal, having been unusually tight for several years. The FPC judges that credit conditions continue to reflect developments in macroeconomic conditions, and banks have managed this while maintaining robust earnings. They have maintained net interest margins at around historical average levels, and their price-to-book ratio have risen in a way that reflects investor confidence in UK banks' ability to maintain returns on equity around their cost of equity. It's not just banks who are affected. The change in funding and liquidity landscape has knock-on implications for the availability of liquidity for NBFIs as well. Banks play a significant role in the provision of liquidity to them, and banks' own liquidity position is one factor affecting their willingness to on-lend liquidity to others, in addition to capital and counterparty risk considerations. The reduction in central banks' footprint in the financial system is in many ways a return to normal, even though it may not feel like it for many employees in the financial sector who haven't known anything else in their careers so far. But it is a new normal, reflecting the lessons learned during and since the global financial crisis about the liquidity needs of banks and of the system as a whole. It's important to consider how different parts of the financial system will continue to have access to the liquidity they need to support the real economy in this new normal. The financial crisis revealed serious inadequacies in liquidity risk management practices by banks and other institutions. And post-GFC reforms have significantly strengthened microprudential regulation and supervision of liquidity risks. And we now have a much greater understanding of the importance of taking a system-wide view of liquidity. The PRA's liquidity supervision framework now includes rules targeted at the key aspects of a firm's liquidity risk management, including the liquidity coverage ratio, the net stable funding ratio, and the overall liquidity adequacy rule. Leverage ratio requirements have also been introduced as a backstop to the risk-weighted capital framework. These guard against the risk of excessive leverage in normal times that could result from the inherent errors and uncertainties in assigning risk weights, which could exacerbate liquidity strains during a stress. For their part, banks have taken the liquidity risk lessons from the crisis on board and managed their liquidity and leverage in a way that is more prudent than was the case prior to 2008. As my colleague Vicky Saporta has set out, the Bank of England has also learned lessons in the way it provides liquidity and supplies reserves. Our operating framework is now accessible to a much wider range of banks, and we have introduced new facilities to supply reserves against a broad range of collateral, including contingent facilities that can be activated in stress. These facilities allow the supply of reserves to expand when needed. For example, if there is an increase in demand for precautionary liquidity in a stress. We have taken steps to normalize regular usage of our facilities in a way which reduces stigma, emphasizing that all of our facilities are open for business. And we continue to learn. The experience of March 2023 highlights the importance of the composition of firms' liquid assets and their ready access to central bank facilities in preparing them to deal with faster, larger liquidity shocks. The PRA intends to identify whether changes to the prudential liquidity framework are warranted to reflect these lessons, with any proposed changes subject to consultation in 2026. Beyond banks, the 2020 Dash for Cash episode and the system-wide exploratory scenario, the SWES, which we ran last year, provided valuable insights into how banks and non-banks behave in a severe market-wide liquidity shock and how their actions can interact to amplify stress across the financial system. And we also continue to assess the liquidity risk implications of new forms of digital money. So both the normalization in the monetary policy environment and the shift in the provision of services from banks to non-banks are major trends for the financial sector. And my key point is this: we need to think about them together, not in isolation. The new normal for funding and liquidity has to take account of the growing importance of market-based finance. Now, more than ever, we need to consider the liquidity demands of NBFIs as well as banks, given their significant role in the provision of vital services to households and businesses. This has changed the nature of liquidity flows through the financial system and the types of liquidity risk we are most concerned about. The funding and liquidity landscape influences business decisions by NBFI, including the level of leverage in the non-bank sector and the types of risks taken by NBFIs. So we need to think about how to support continued provision of vital services by NBFI in normal times in a way that avoids unsustainable risk-taking and leverage, and that supports the financial system's ability to self-manage increased liquidity demand and self-stabilize in severe but plausible stresses. To ensure the central bank needs to step in only in extreme scenarios, not more often. Unlike banks, NBFIs are not able to hold central bank reserves. They do not have the power to create money in the form of commercial money. And they do not have regular access to central bank facilities, reflecting the different role they play in the financial system. This poses a unique challenge in ensuring that liquidity flows to them as well as banks. And it means that banks will continue to play a major role in providing liquidity to them, reflecting banks' special role in the financial system, including their expertise in maturity transformation and credit risk management. In sterling markets, one of the most important conduits for liquidity flows between banks and NBFIs is the gilt repo market, as it allows participants to effectively lend against gilts as collateral. What we are talking about here is quite different from the type of leverage that banks provide to the private equity ecosystem, which does not involve the gilt repo, but rather loans secured against collateral, which is illiquid and hard to value. I have talked about those risks before. With only a few notable exceptions, over the past decade, the gilt repo market has remained a liquid and well-functioning market. Far from shrinking in the face of abundant central bank liquidity, as some predicted at the outset of quantitative easing, repo activity as a proportion of banking sector assets has remained broadly in line with pre-GFC levels. This is in part due to the increased activity in NBFIs and reflects the unique role of the repo market as a major vehicle through which banks are the main providers of liquidity and with it leverage to non-banks. However, recent experience has shown that despite its size and liquidity in normal times, this crucial market can come under pressure when demands for liquidity, particularly from NBFIs, increased in a stress. In the 2022 Dash for Cash episodes, gilt repo market functioning deteriorated sharply as market participants, including UK-based dealer banks, were unable to satisfy increased NBFI demand for liquidity meet margin calls and redemptions. The LDI crisis also highlighted the difficulty in getting liquidity to flow where it was needed in stress. However, the challenge there was different, as LDI funds needed less leverage, not more. And while pension funds had the incentives to borrow, they lacked the ability to do so in effective or timely ways. So even in an environment of abundant central bank liquidity, there were impediments to liquidity flowing from or through banks to NBFIs in a stress. This is consistent with the findings of our system-wide exploratory scenario, which showed that despite higher NBFI demand for liquidity in the scenario, most banks had very little, if any, appetite to increase the amount of repo finance they extend to non-banks. This was largely driven by counterparty credit risk concerns against the backdrop of often zero haircuts. A deterioration in gilt repo market conditions can amplify forced gilt sales, threatening dysfunction in cash gilt markets. These two markets play a crucial role in the pricing of risk-free assets, which in turn underpins a wide set of other transactions. They help liquidity flow around the system, ultimately funding the provision of vital services to households and businesses. Because of this, dysfunction in these markets has costly implications for the real economy. That's why one of our financial stability priorities is to enhance the resilience of liquidity in core markets, including gilt repo. It is natural to expect these markets to be impacted by large shocks, as it is likely that demand for liquidity will increase and participants might become more risk-averse and limit their liquidity provision. But we want to make sure that the structure of these markets and the incentives participants face mean that these impacts are manageable and that core markets remain sufficiently resilient so that they do not amplify the initial shock. In 2023, the PRA completed a thematic review of regulated firms' liquid fixed income financing or matched repo book businesses, sharing observations on the lessons learned from the large fluctuations in gilt markets in September and October 2022, and expectations that firms should incorporate these into their risk management practice. We will soon publish an exploratory discussion paper on potential measures to build gilt repo market resilience, such as greater central clearing of gilt repo and minimum haircuts or margin requirements on non-centrally cleared gilt repo transactions. It will also see views on a broader range of other potential initiatives. And we have already enhanced our toolkit to step in through the launch of our contingent non-bank financial institution repo facility. While our preference remains for liquidity to flow via banks from our regular lending facilities to NBFIs, we recognize that in periods of very severe stress, intermediation capacity constraints can prevent banks from lending at sufficient scale to prevent spillover effect resulting in gilt market dysfunction that threatens UK financial stability. In such extraordinary situations, the CNRF provides a means of channeling liquidity directly, financially sound and resilient. Notwithstanding the progress made, we're only part of the way through the journey to this new normal, and we'll continue to learn and adapt as we go. Because of the unique role we play as both a central bank and a regulator, we have a number of levers that can affect the overall funding and liquidity landscape. These include our monetary operating framework and the terms on which we provide liquidity to the system, the regulatory framework for banks, including liquidity and leverage ratio policies, and policies relevant to the markets in which banks and MBFIs operate. In using those levers, it will be important to be clear about what our objectives are, to ensure that the set of policy choices we make across them is coherent. Clearly, our overarching goal is to deliver the bank's core statutory objectives of monetary and financial stability. But within that overarching role, we can set out three objectives. First, whatever frameworks we have in place, it is vital to maintain monetary control. As my colleague Vicky has set out, monetary control can be achieved under a range of different operating frameworks, although some frameworks may be more robust than others to unanticipated shifts in the demand for reserves. Second, individual banks should maintain enough liquid assets, including reserves, to meet their own short-term stressed liquidity needs. Take into account their ability to liquidate these assets either with us or with the market. While this has always been important, management of liquidity risk prior to the GFC proved to be inadequate. Microprudential liquidity regulation and banks' liquidity management practices have since improved substantially, as I said before, and banks need to continue to adapt to changing liquidity risks, including the possibility of faster liquidity shocks in a digital world, as highlighted by the experience of Silicon Valley Bank in March 2023. And finally, reflecting what we have learned since 2008 and how the financial system has developed, it's important to supplement these monetary policy and microprudential aims with a macroprudential one, namely that as well as ensuring that market rates remain close to bank rates and that individual banks can withstand liquidity stress, we seek to ensure that liquidity can flow around the financial system to get where it is needed most. By that, I mean that banks and other financial institutions are appropriately incentivized to lend to one another, including in stress, thereby achieving an effective degree of liquidity recycling across the whole ecosystem. While some impact on liquidity provision in a severe stress is inevitable, we want core liquidity markets to be resilient enough so that they help to absorb rather than amplify the initial stress. There will be choices in how we use our policy levers to achieve these objectives. For example, the level of reserves banks choose to hold in normal times and the way in which we supply them will affect their level of asset encumbrance, which is how much of their assets are pledged or otherwise committed to us we use in our repo facilities. But as banks encumber more of their assets with us to obtain reserves through our repo facilities, it is important that they also maintain enough dry powder to source additional reserves from us in stress and also consider what collateral they have available to source liquidity from private sector funding markets. To meet these three objectives, we need to ensure that our decisions on the monetary operating framework and regulatory framework are coherent and tread a middle road as we make these choices. This middle road should ensure sufficient incentives for individual institutions to maintain liquidity insurance themselves, and also provide incentives for them to support the liquidity of the system as a whole by lending in financial markets. And we need to ensure that funding markets are liquid and resilient in both normal and stressed times, paying close attention to how our policy choices can affect this resilience. That means ensuring liquidity is cheap enough to allow sufficient market depth in normal times, but without encouraging a buildup of unsustainable leverage in the system, which could unravel. Primary responsibility for managing liquidity risk lies with financial institutions themselves, and this applies to both banks and NBFI. When managing their liquidity needs, banks should take into account their ability to use our lending facilities regularly for routine liquidity management, which we encourage and welcome. We want to avoid any stigma around routine usage of these facilities in normal times so that they can be more effective in stress. NBFIs also need to take a prudent approach to their own liquidity risk management, taking on board lessons from previous periods of market instability, such as the 2022 liability-driven investment deficit. That said, we also want to create a funding and liquidity environment which incentivizes banks and non-banks to participate actively in private sector funding markets, rather than hoarding liquidity excessively. This means that we need to be cognizant of potential distortions to banks and NBFIs' incentives to lend to one another and their capacity to warehouse risk in both normal times and in stress. We want to encourage the efficient distribution or recycling of liquidity across the financial system and to support the efficiency and depth of intermediation in core private sector funding. The resilience of these core markets to stress remains crucial as they underpin a wide set of transactions that ultimately support the provision of services to household and business. And it's important that market participants, including NBFIs, maintain their own liquidity resilience so that these markets can self-stabilize in response to most shocks. The less efficiently private sector funding markets distribute liquidity in normal times, the less trained they are to cope with shocks. And therefore, the more likely it is that central banks might have to step in. Situations where central banks have to make extraordinary interventions should be rare, but we cannot eliminate liquidity risk altogether, and it will remain the case that some shocks are so severe that intervention will be appropriate given the threat to UK financial stability. What we ultimately care about is how the provision of vital services would be affected. So as well as thinking about individual institutions' liquidity needs, we need to consider how significant a role they play in providing those services, as well as the potential for their liquidity stress to spread to other parts of the financial system. Given the growing significance of NBFIs, the CNRF is a valuable addition to our toolkit if we do need to intervene. Let me conclude. As I've set out in this speech, there are a lot of factors impacting future liquidity conditions for banks and non-banks that we need to consider together in the round. Normalization in the monetary policy environment affects the overall level of system-wide liquidity, and the calibration of our repo lending facilities determines how banks can access liquidity from us. Banking regulation, including liquidity and leverage ratio policies, affects banks' demand for holding reserves and other HQLA, their capacity to warehouse risk, and their incentives to distribute excess liquidity to other financial institutions. And there are a range of policy initiatives we can consider to improve the resilience of markets that are core to the distribution of liquidity, such as measures to encourage greater central clearing or minimum repo haircuts. All of these factors affect the liquidity available to non-banks, and hence their ability to support the real economy. And given the larger role market-based finance now plays in providing vital services to households and businesses, this is very important. In considering these different factors together, it is helpful to apply a macroprudential lens, which considers how liquidity flows around the financial system. If we get the calibration of incentives right across our monetary operating framework and regulatory frameworks, reserves should be neither scarce nor abundant, just ample. Banks would maintain an appropriate level of reserves for their own liquidity management purposes, taking into account the predictability and reliability of the bank's liquidity provision. And outside of periods of exceptional monetary stimulus, they would also have incentives not to hoard excess and unneeded liquidity, and would instead redistribute it to the rest of the system where it might be more needed. Let me end on a practical note. Balancing the principles set out above to achieve the right calibration of incentives requires coordination on our part to ensure that policy choices are coherent across monetary operating framework, our microprudential functions, and our macroprudential functions. Fortunately, the UK's institutional arrangements are well suited to this, since the Monetary Policy Committee, Prudential Regulation Committee, and Financial Policy Committee are all housed under one roof. And that coordination is happening. We look forward to thinking through these macro issues in collaboration with the industry towards a steady state, which sets up the financial sector well to support households and businesses in a range of environments. Thank you.
Thank you very much. Thank you, Nat, and well done for having a half-hour speech where you didn't mention tariffs once. That's very nice to have. If I may just start off with a couple of questions and then open the floor to the audience. I thought at the end, when you started talking about coordination, you were perhaps going to talk about European coordination. Because it seems to me that these two big trends you're talking about, one, the move towards the importance of the non-bank financial institutions, and then you mentioned digital assets. You know, these are international trends, aren't they? So I'm sure that there is some harmonization going on in attitudes on that. You mentioned central clearing, for example, for gilts. I mean, there must be the same conversations going on about this, I would have thought, in other financial capitals. So given the fact that we had the famous Northwood Declaration last week on nuclear weapons, and tomorrow we'll have Mr. Mertz over here talking about all kinds of people-to-people exchanges and so on. It seems that European coordination is very much in the air. In these big fields, how are we in the UK harmonizing with the ECB and other bodies on the continent to try to get this right, not just in the UK, but across a wider sphere?
I mean, I think you're right. And I'd say several things. So first, in terms of the broader context you describe, this coordination is particularly important to the UK because it is a very open economy with a very large financial sector, and therefore, collaboration with what happens abroad matters a lot. Matters a lot to the UK, as we could see in a number of instances. I mean, the good thing is that there has been an excellent level of collaboration with our friends, towards on the other side of the channel and the other side of the Atlantic. And that's been going on for a long time, actually. It's not a new thing.
Are you a member of some ECB committee of some sort of ex officio
well, I think
member?
we don't need sort of I mean, there's already plenty of committees around, so I don't think we need more committees. But the level of dialogue we've had on a number of those issues has been very high. Where it all comes together, where some of this all comes together, for example, is at the level of the Financial Stability Board. And part of the role of the FSB is precisely what you just described, is to bring together different jurisdictions so that we think about it in the round, and so that together we create a level playing field for business which is global. And that is very much happening. Just specifically on the, so you mentioned clearing, central clearing, for example. The US have already done it. The US are going for it. So the SEC is leading the US's efforts to clear the repo market in US Treasuries, for example. So these things are happening, and those topics are very much discussed.
And for instance, on the digital asset side, will there be some kind of harmonization with the ECB or with the other European regulatory authorities on a regulation of stable coins? Because that does seem to be an issue where the United States is clearly going in one direction, and no doubt putting a bit of pressure on the UK as well to do likewise. And then you've got continental Europe taking a somewhat more conservative line. How does Britain fit into that triangle?
Yeah, so the short answer is that this is an issue we're discussing quite actively with our colleagues abroad. And you are right. There's a lot of new things happening at the moment. So it's more important now than ever that we do maintain that dialogue, and indeed that these opportunities and these risks are discussed in the international setting.
And the other question I wanted to ask just before we go to the audience, so do have some questions ready, is this issue about QT, because clearly we are in a system with lots and lots of different moving parts, and you spoke about the whole nexus of guilt quite a lot in what you were talking about. Has there been any decision on this, whether we'll kind of maintain this steady state of the QT where we know, in the time-honored maxim of paint drying, you're supposed to know how many gilts are going to basically be sold back to the market in any one year? Or could you try to keep the market guessing a bit on this, just to give a little bit of extra volatility, a bit of extra uncertainty and so on, which might fit in quite well with the ability of the central bank to guide the market through some difficult periods?
I mean, on that, I'm afraid you're asking the wrong person. I mean, this is a matter for the Monetary Policy Committee, which is independent, which is a good thing. But it is, and the governor has already spoken about this very question that you pose, and this is something the MPC looks at every year.
He's simply saying that they're looking at it, so no decision has been taken, has it?
They're looking at it.
Yeah, I mean, clearly all this does have a role to play. Well, we've got two former distinguished members, external members of the MPC here. Well, I'm sure they know all the answers to these things anyway, but they are very welcome to ask a question, and indeed any of you. So who would like to open up the batting? Yes, please, sir. And we have a microphone circulating here. Yes, and maybe if you just tell us your name, just for those people who are listening online as well. They are not allowed to answer any questions as a punishment for not being here. Only the people in the room are allowed to ask questions, but people online may listen, of course, to the answers.
Bernard Casey from Social Economic Research in London and Frankfurt, and I'm very glad to be here in person. You talked about banks and non-banks. We tend to know what banks are, we think we do, but we know that non-banks are a very heterogeneous group. You tended to talk about responses and reactions and policies towards them because it was a heterogeneous group when it is very clearly not. You did mention dashes for cash and you did mention LDI. Those were rather different things. So can you say a little bit more about how you differentiate within the non-bank sector?
Yeah, it's a very good point. So I try to draw at least some difference when I try to make clear in the speech that I was not talking about private equity and private credit, which is one form of non-bank finance. The way, so I mean, as you well know, there's a great variety of non-banks, hedge funds, asset managers, pension funds, money market funds, etc., etc. And when we focus on those things, and I think that heterogeneity is why we need to be really clear about what question we're asking. And in exercises like the system-wide exploratory scenario that we ran last year, we're very clear about the question we're asking. The question was the resilience of markets that are core to the functioning of the economy, the gilt market, gilt repo market, and associated market. And our question was, if a shock happens to that market, how does it play out? And how does the ecosystem of participants in those markets react to the shock? And how do those behaviors interact with each other? Our interest there is not really any one constituent, any one type of non-bank. It is the functioning of the market and how the participants in those markets react, and whether that amplifies the shock, whether that doesn't, etc. If I push that point to its extreme, it means that, in a sense, we're only interested in the functioning of the markets. If one non-bank, has a bad time because there's a shock that happens, and if that has no impact in any market that is core to the UK, it's their problem. So our focus is really the functioning of the markets.
Good, thank you. Gentlemen here, please.
Hi, Tom Rees from Bloomberg. The current leverage ratio policy treats reserves and gilts differently. Would you consider a change to these arrangements in order to encourage banks to hold more gilts rather than reserves as we kind of move to this new liquidity environment? We've seen some banks call for that.
So, I mean, just to be clear, this is something that the Financial Policy Committee reviews every year, and this year is no different. So, the question before, it's the committee takes a look at it every year, and every year we
So when are you looking at it next?
In a few months.
Like
every year. So nothing changes basically. So sorry.
Do you see a case for changing that?
I think we look at it on its merit every year. We have dialogues with the banks on the benefits of the current arrangements, and that is that feeds into the decisions on that.
And just related to that, something about the centrally cleared gilts you were talking about, will that make a difference to the capital ratios? You seem to indicate that there'd be some tiering.
So that's really interesting, because one of the things we found when we ran our system-wide exploratory scenario is, so the value of it is it was a flow stress test, not a stock test. So we actually let the story play out over time. We did it in several rounds. We didn't do a shock. How are you affected? Look to each participant. How are you affected? And especially, what are you assuming that your counterparties are going to do? Do you think you're going to have access to more repo? Yes or no? And then someone tells us, well, we ask the counterpart, are you going to give them more repo? And often the answer we got was no. And interestingly, the answer we got a number of times were no, unless that counterparty is cleared. So the constraint
is killed.
Is cleared.
It's cleared. I see.
No, not cleared.
I thought you might be using that in a metaphorical sense.
We're not that brutal in financial stability, no. And so this is really interesting, because it means that a clearing relationship with a counterparty reduces the degree of counterparty risk, and those have been typically the constraints in people's willingness to extend liquidity It hasn't been, in our exercise, leverage ratio constraint. It has been more internal risk limits and risk appetite to lend to this versus that type of organization under stress. That has been the biting constraint, which is why things like central clearing means you are suddenly facing a much safer counterparty. Therefore, you're using your credit limit much less than you would otherwise be, and therefore you have more capacity to do more lending. So that's the type of dynamics we observe.
Yeah, please. Yes, so let's have the lady here first, and then the gentleman behind.
Thank you. Gülçin Özkan, King's College London. So there is emerging evidence on the importance of climate risk, whether it's physical risk, transition risk, or climate uncertainty risk for macroeconomic outcomes. How concerned are you as a financial policymaker for the implications of those risks for financial stability? And what would be your most effective instruments to respond to that?
Yeah, that's a very good question. We actually published our approach to the financial stability impact of climate risk a few months ago. So I would point you to that. But to directly answer your question, I mean, the way we've been thinking about this, we're currently going through this period of transition for financial system, the macroeconomy, away from an era, as I was discussing before, of a very ample monetary stance, with very low interest rates, abundant liquidity. That is changing. There's tightening in monetary policy. That is one factor that characterizes this transition we're going through. Another one, we talked about digital assets. That's another big driver of how the world is changing, is digitalization. And the third factor is indeed climate change. So those are the three determining factors that are shifting the outlook for the financial system into a new era. Now, one clear way in which we are incorporating this reality is to basically treat climate transition, physical risk from climate, as a core part of how we assess financial stability, not as something separate or different. I mean, we did separate exercises in the past. We did the climate stress test in the past. But more and more, part of our intention is to reflect those factors into, for example, the stress tests that we do. So when we think about stress testing different parts of the financial system to shocks, those shocks have to be relevant in the context of a climate change and climate transition. If you think about, the risk from floods, for example, the risk from assets where, climate transition may or may not be priced in. Those are the type of things that you can factor in the scenarios that you consider when you think about stress testing. And as you know, stress testing is one of the key tools we use to evaluate risk to financial stability. So that gives you a bit of an idea for things. But there are other ways in which we are incorporating climate into how we think about financial stability. I want you to our strategy for that. But the big picture is that it's not something separate that's just out there. It's core part of how we think about financial stability.
Just before we go to the next question, just as an ancillary on that, I recently met a lady who's the chair of the NGFS, and she said this NGFS has never been so popular amongst central banks since when Mr. Trump somehow declared war on it and the Federal Reserve retired themselves from it. Have you found this yourself, that people come flocking to the things that you're doing which involve climate change? As you say, that's becoming more consolidated within the overall framework these days.
I think it's a big, getting into the mainstream of how we think about things.
Of course, it is the 10th anniversary, I think, in September of Mr. Carney's famous tragedy of the horizon speech at Lloyd's. And I do hope the Bank of England will be laying on an anniversary event to commemorate that. So Mr. Lakshmi is just here, and then we go over to Tinran, to Silvana. Yeah, so just behind. No, back there. Silvana afterwards.
Lakshmi from the Indian Embassy. Given your experience, could you share your experience of stress testing with banks, especially with the field like, did you find any new interesting observations or learnings when your engagement with banks, especially in the context of this policy uncertainty, whether there is excess reserves which are built in banks, which is affecting growth at large in the UK economy? Thank you.
So we learned a lot from the stress test that we do with banks. We've just also published recently a an updated approach to stress testing the banking sector. So I would encourage you to take a look. And one of the new things we are doing on that front is we've moved away from every year doing a massive set piece exercise where, soup to nuts stress test of, capital adequacy under a shock. And we've pivoted towards more exploratory scenarios. So instead, we're doing our full-blown capital adequacy stress test every second year instead of every year. And then every other year, we'll use that flexibility to do more exploratory what-if stress tests. So for example, last year, we did not run a full-blown bank capital stress test, which then informs capital requirements for banks. Instead, we used a desk-based stress test, which is something we just do ourselves. We don't ask for bank solution. But what that enables us to do, without causing any burden on firms, is to see how the banking sector as a whole would react to two orthogonal scenarios, mutually exclusive. They can't happen at the same time. It's either a supply shock or a demand shock. Interest rates either go up or they go down. They can't go up and down at the same time. And the advantage of being able to test very different scenarios is that you don't need to guess which one is more likely. You just understand what would happen in any of those mutually exclusive paths. So that's the advantage of being more nimble.
Did you do that as part of a test to make yourselves more intellectually busy, or did you do it to somehow spite all the banks who were expecting you to show up, you didn't show up, and therefore you made them maybe more frightened of you by not showing up there?
I mean, no, don't worry. Generally, we're not bored, so we've got plenty to keep us.
What was the reason for doing it like that?
The reason was, one, we felt it was enough to have run the previous year a full-blown soup to nuts capital stress test to reassure us that banks were strong enough. So we had that reassurance, and we wanted to find out, given that there was a lot of volatility, a lot of uncertainty in the environment, where generally we did not know where things might go. So the best thing to do is not to try and agonize about trying to guess, but actually test the different ways in which things can go. And one of the really useful things is one stress test can inform another. So we found that one of the shocks was more damaging, and we picked that one to be the next scenario for our full-blown stress test. So that's something we want to do more and more over time, is to use the result of some stress test of some time to inform other ones and to grow more system-wide as we do that.
Thank you. So Silvana Tenredo.
Apologies, actually, we have an online question from Reuters, which we would like you, David, to read out.
All right. Well, I suppose since it's Reuters, we'll allow just this once. Okay. So the question is, do you think the BOE's liquidity toolkit is now complete, or do you think different types of repo or other measures will be needed in the future?
So I mean, I think we've got a good toolkit in our toolbox. I mean, as I said, our toolbox is bigger now than it was before. We invested a lot of work since almost more than 10 years ago to make sure that toolkit was rich, that we could lend against a very broad range of collateral at different terms. We have shown also in the past that we were able to put new tools in the toolbox if we felt they were needed, and you retain that ability to do that if we judge that's needed. But it's a really good question. At the moment, the toolkit is very good, is very important, and something I've said on separate occasion is that it is important to have a rich toolkit so that we can deal with shocks that really only the central banks is able to do.
Very good. Well done. That's not going to make any headlines on Reuters. So I'm sure that's a very good reason for giving that very good answer. So we will now, after that short break, go over to Silvana.
Silvana Tenreiro, London School of Economics. Thank you for a great speech, Nat. I have two related questions. The first one is, what's the bank's current estimate of the appropriate or just sample level of reserves, ballpark? And second, how are you thinking about the conversion of the APF holdings to standard bank reserves? When will that happen and how?
So I mean, obviously, I can't say too much about either of those things, but I try to give elements of answer to your first question. And the hint is in the difference between the three terms, scarce, abundant, but scarce versus abundant versus ample. So we were previous to the 2008 crisis in a world of scarce reserves, and afterwards in a world of really abundant reserves. So the broad answer is it needs to be, lower than at the sort of a peak of the QE time, lower than that, but not as low as what it was before the financial crisis. Now, exactly where we will see, and as Vicky Sapota and other colleagues said, we will learn by doing. So as gradually QE is being unwound, we're together with the industry, together with the banks and other institutions, we are actually learning and discovering where the natural demand for the preferred range actually sits and demand for reserves actually sits. So we're doing this gradually. So the answer is we don't know, and it's almost deliberate that we don't know, because it's something we're learning together with the industry. So more than before 2008, but less than the last decade is the short answer. And we will learn by doing, in a sense. And your second question was, so the content, so I think it's, and I think colleagues have already. So the idea is, as the APF gets unwound, and I think that's also more a question for on the MPC side of things. But as the MPC, as the APF gets unwound, as the stock of gilts gets unwound, as we get closer to the preferred range for reserves, then our repo operations are picking up, and we're already seeing, which is really good, a pickup in our repo operation, the short-term repo, the long-term repo, and that's exactly what we want to see. Is a substitution, a gradual substitution of how the reserves are being provided, and that's, I expect that will continue to happen as the APS is being.
And just related to that, when do you think roughly that point will come when you are getting to a kind of crunch point where perhaps you are getting to too low? I know you can't say what is going to be too low, but also, is that going to be around about the same time as the ECB comes to that? There's another area for European coordination, perhaps. So they keep telling me it's always going to be in 2 years. It's always 2 years whenever you ask them. Is it the same with you?
I can't give you any precise estimates. I would say I think we went down from 980 billion in total. We're now at 680 billion, and I think we still have some way to go. And that point of crossover is coming closer. I can't give you a precise estimate. What is though interesting is that there's been different places and different resting levels across different jurisdictions. That's an interesting point, and it's very relevant, especially given that I was saying before, the financial sector in the UK is very international, it's very global. But actually, it's not just the pace of unwind in the UK that matters, it's also what happens abroad, as you say, in the EU and in the US and in other jurisdictions.
So we've got time for a few more questions. There's a gentleman at the back. Yes, there's two, please, one after the other. Yeah, thank you very much.
Hi, thank you for the speech. Thomas from Central Banking. You mentioned in your speech the importance of banks being operationally ready to access central bank liquidity, having the collateral ready, and this is something that regulators in other parts of the world have emphasized as well. Now, the Federal Reserve and the Swiss national banks have explore the idea of introducing a minimum collateral requirement, or in other words, collateral pre-positioning. Do you think, can you explain a little bit more on, do you think this would be a good idea to mandate banks to pre-position some collateral at the central banks to access the facilities? Thank you.
I don't think, thankfully, we're not really in a position where that question poses itself for us, just because there are very large amounts already of collateral that is prepositioned with the Bank of England. We've done a lot of work on that with the industry, with the banks since 2014, even earlier, and there is a lot already prepositioned, and it is part of the discussions that are happening between us and the banks on a regular basis, in ways that means that it doesn't feel there's a need for mandating. Is just a huge amount of that has already happened in a sense, and it's a natural part of the conversations we have with firms.
Good, and then please, you sir, with the gentleman with the beard.
Thank you. Right, so one observation and one question.
Sorry, what was your name again?
Alexandros Kotonikas from the University of Essex.
Oh, yeah.
So in a counterintuitive way, when you do QE and the counterpart is non-banks, you can increase the exposure of banks to liquidity risk. If we unpack it, how does it happen? you buy assets from the non-bank, the deposits of these non-banks to the banking system are increasing, and these deposits are typically treated as very highly flighty, 100% run-off rates. So in a recent paper, we take the COVID QE as the example, and we show that American banks reacted to this increasing liquidity risk by cutting credit lines and by trying to get more insured deposits. So the question is, did you observe this type of phenomena during the recent QE periods at the Bank of England?
No, we did not observe cutting of credit in the dynamics you describe. Actually, if anything, we've seen credit conditions improve and credit provision pick up.
So I can just put a final question, Nat, and I mentioned this at the beginning, the United States, and it's come up a few times here, and after all, your opposite number has been the Federal Reserve Board. There's two things, really. One is that people are talking a lot about the importance of the Federal Reserve swap lines as the ultimate safety net, if you like, if things get really dicey. And there's no substitute, really, for that. However many dollar reserves there are in the world, they will end up in the United States, or they start from the United States. So is there any element of stress testing that you might do, even in your wildest nightmares, which would include the cutting off or the very selective use of swap lines by the United States in a moment of crisis to certain countries which may or may not meet certain criteria?
I mean, I know this has been, there's been, stories about that. I mean, the reality.
You could always add to them if you wanted to.
No, not really. I mean, our friends at the Federal Reserve have been extremely clear about the importance, as you say, of swap lines as a global backstop for the global economy. You just have to listen to what they have said themselves, and we have seen no change whatsoever in the level of operational arrangements on this.
Yes, and then related to that, I have spoken to some of the people connected with the FSB who say they were somewhat worried about the nomination process in the United States, about new people being brought on to these different regulatory networks. Whether or not this has actually happened or not, I really don't know, but quite authoritative people were saying they were worried about the quotes, quality, end quotes, of the people being nominated for the FSB opposite numbers, if you like, in the United States. Would you like to comment on that at all?
Not really.
Well, I think you've just made sure that your career in central banking is going to continue effortlessly. But I mean, it is an issue that I think is preoccupying people. But maybe
what I would say is that we have throughout continued to have excellent engagement from our colleagues at the Federal Reserve. That has not changed.
It's not the kind of question you can really talk about online with all sorts of people listening in, is it? And therefore, I think we have to rely on the Americans always doing the right thing in the end, as Winston Churchill always told us they were going to do. So on that note, Nat, thank you very much indeed for being with us today. It really has been a great pleasure to listen to all these. And I actually do think that talks without slides are better, because it really means you concentrate on the words. And I think the words have been extremely helpful. Thank you very much indeed.
Thank you.